Thanks for joining, everybody. Those of you logging in, we have Brian Duffy from Morningstar Wealth. Brian's job is basically to take the nerd data from Morningstar, break it down into information and thought processes that we can understand. So we're going to have him run here for the next little bit, and we have a slide in here as far as questions. The interactive features in the meeting today don't work; they're disabled. So. We have a texting line, or you can email me. We'll show that slide here in a few minutes. But without further ado, Brian has 15 years of experience over now, looks like. It's probably an old slide, but lots of experience with several different companies, and we're excited to have him on. So thanks for joining us, and I'll kick it over to you.
Thank you very much, Ian. I appreciate it. And, certainly welcome to everyone on the call. Really appreciate the opportunity to be here and just love being a partner with you guys, at least from our perspective here at Morningstar. I hope everyone's having a good morning thus far. So as Ian mentioned, I'll dive into kind of what the markets did over the course of, 2023. Go through some slides around, what are we seeing in terms of leading economic indicators, how have certain indices performed, why are they performing that way, et cetera. And then as time permits, I'll get into a little bit about, what are our forward-thinking thoughts, looking up, over the horizon into 2024 and 2025. So I will go ahead and share here. Please let me know if you can't see my screen. As Ian mentioned, here's the slide that, displays. If you'd like to ask a question, you can text the number on your screen, or you can email Ian directly, and he should be able to see it from his perspective. So I thought I'd just take a few minutes to give a brief update or an overview of who we are as a firm here at Morningstar, if you're not totally familiar with us. We are a firm that began in the early 1980s, early to mid 1980s. Built as a research firm, grounded in objective research. That's kind of our bread and butter at the end of the day. That's what we're known for. If you've heard of Morningstar, whether you've seen it in the newspaper or on television or something to that extent, it's probably has to do with our research capabilities to at least a certain degree. But after a while, we were fielding questions from financial advisors. They're saying, hey, you have really great research. Do you actually manage portfolios underneath the Morningstar umbrella? At the time, we hadn't done it in the capacity that we do it now. And so that was the start of our business back in 2001. And, we've been doing this ever since. And so you can see here on the screen, this is a few of our guiding principles. It's kind of how we do our business day in and day out. And it's our North Star at the end of the day, if you will. And so I think the most important one here is that we are putting investors first. I think a big value add that we had to the investment community, from the beginning of our company, was that we were able to democratize investment research that was once only available to, really high net worth individuals or institutional investors alike. It just wasn't, the information just wasn't that mainstream. And then Morningstar came around, and we were able to get this information into the hands of everyday folks. And that's what we like to do. And that's, ultimately what we are here to do. And so putting the investor first is, incredibly important to us. As I mentioned again, we're grounded in objective research. So we really pride ourselves in being independent minded at the end of the day. We take a long-term view on the market. So we have a long-term orientation. I don't want to say we ignore the day-to-day, but we don't necessarily, we don't let that change our long-term views, day-to-day noise. When we are looking at an investing horizon, we are looking over the course of, call it 10, 20, 30 years. We're not looking to capitalize on opportunities that, may change over the course of a couple of months or a couple of weeks or something like that. We are valuation-driven investors. That is our investment philosophy. That is our theme. You hear of a lot of different investing styles in the marketplace. You may hear, relative value, momentum, quality, all sorts of different investing styles. We're pretty bland at the end of the day. We are valuation-driven investors. And so when we look at the opportunity set of investable assets, we are looking at everything through the lens of being valuation driven, in the sense that we think every asset class that produces cash flows has an intrinsic value associated with that that can be derived from the cash flows that they produce. We look at what the intrinsic value is of every investable asset class that we touch, and then we look at where that's trading in the market and we construct our portfolios accordingly. We don't want to overpay for assets. We don't want to overpay for any security. So we're always looking at that intrinsic value as our guidepost, if you will, and that helps us construct our portfolios at the end of the day. We do this with a fundamental approach. So again, we are not trying to time the markets here. That is not what we are in business to do. We look at tangible things that companies produce. We look at the underlying cash flows. We look at earnings growth over time. We derive intrinsic value off of that, and then we construct our portfolios accordingly, like I said. And then at the end of the day, of course, we want to democratize things again as much as possible, and we want to minimize costs in a way, to facilitate, everyday folks being able to invest with our products. So we are always trying to be cost effective at the end of the day. You can see here's a snapshot of our organization. I think this is pretty compelling because it does demonstrate our global footprint. You can see here that we, advise and manage to about 265 billion or so in assets worldwide. And we do have a presence in most regional investment hubs around the world. So obviously our headquarters is in Chicago. We've got offices in London, Sydney, Hong Kong. As a representative of the portfolio management team here at Morningstar, I can truly attest to the global feel of this firm. I work with different colleagues on our portfolio management team from all different corners of the globe. I'll wake up in the morning and I'll have messages from folks in Australia or Hong Kong or whatever it may be. So we are truly connected at the end of the day, and we really feel that having a local presence in the major regions around the world is how we deliver the best outcomes and solutions for clients.
Hey, Brian, can I jump in for just a second?
Yeah.
Can you go back one more slide?
Yep.
So one of the question / comment, you mentioned the independent minded building portfolios. A lot of folks are familiar with Morningstar because of the research side of things, and that's a lot of what we'll talk about today. But one of my just kind of like nuggets inside here is that independent minded, like clients, investors first. I know that you have some mutual fund portfolios, but a lot of your strategies are designed not with your mutual funds, with other investments. And so in that kind of independent analysis, they truly do lean outside of it's not just hey, I'm X fund company and we're gonna use our funds. It's how do we build out what's in the client's best interest based on the portfolio you're building.
Yeah, absolutely. We always want to pick the best available manager in a particular space that we are trying to target. So if you were to look into one of our multi-asset models, certainly we have our own products, but you're not going to see our multi-asset models just be completely filled with Morningstar, proprietary funds, if you will. We partner with other investment managers, very much because we want to access the best available investing minds that are in the marketplace.
Cool. Thanks. Sorry to derail you.
No, not at all. So we can get into some of the numbers a little bit here. So looking back at 2023, a relatively strong year for investment performance, certainly a welcome, environment, if you will, when you compare that against the backdrop of 2022. I'm sure most folks don't want to remember 2022. We'll remember it for pretty negative reasons. It was a historically bad year. Bond markets, equity markets, both down. That doesn't happen very often, at least to the extent that it did. We saw double-digit negative returns on both the equity and the bond side of things, which really highlights and underscores the difficult investing environment that we saw over the course of that year. It was nice in 2023 that we saw at least a turnaround on the equity side of things. You can see the blue bar, which represents the S&P 500 performance. There was that sharp downturn in 2022. And then you can see at the end of 2023, that index was up 26%. So that was certainly a good turnaround there. Bonds were positive on an absolute basis, but you can see, relatively speaking, did underperform equities, having been up about 6% for the year. Not surprising, considering that's typically how bonds and equities, perform against one another. In a riskier type market where folks are willing to take risk and equities do pretty well. You generally see bonds do well, but not to the extent that equities do. So, certainly nothing surprising there. But like I said, a nice turnaround off of that bad 2022 that we saw. So what is, ultimately driving the markets? What are we seeing going on in the broader global economy? Well, I think if you look at any sort of newspaper, or you turn on the television, or look at the internet, or whatever, you're going to see something about inflation. Inflation was soaring very, very high not too long ago. I believe, what was it? Maybe a year and a half ago, we were at 40-year highs in inflation. Inflation was up to about 9% year over year, extraordinarily high. Luckily for us, in terms of where we stand here today, inflation is coming down in the right direction. You can see that the CPI index, which represents the price of a basket of goods generally, is down to about 3.1%. So when you compare that to the historical average of about, call it 2.5%, we're still elevated, but relative to that 40-year high that we were at not too long ago, the story is much, much better. So we are seeing inflation come down. Here's the slide again for questions. If there are any questions along the way, please feel free to stop me. You can see here that another thing that is, pretty prevalent in the markets today, and certainly the broader global economy, is the tight labor market. When you look at something like unemployment, it is very low right now. You can see the average unemployment historically is trended at about, just under 6%. Where we stand as of the end of November, the unemployment rate was about 3.7%. So we are underneath the historical average. And as long as that labor market stays relatively tight, meaning, unemployment's low, there's availability of, there's good data behind that. I think there is a lot to be, looking for with market performance, at least in terms of, hopefully positive returns, because the labor market has pulled the broader market for quite some time now. You can see that wage growth is high relative to average as well. The average from about 1990 to 2010 has been at about 3.3%. Historically, when you extend that window a little bit more, a little lower at about 3.2%. And you can see that where wage growth is right now, it's at about 4.3%. So high wage growth, low unemployment, that is helping to drive investment returns. That is helping to drive the market. And as long as those numbers kind of stay in those camps, if you will, I think the markets are going to be pretty resilient and strong. What are we seeing with interest rates? Obviously, it has been a difficult time with respect to kind of the movement of interest rates. This here shows the 30-year fixed mortgage rate. I'm sure most folks on the call are pretty in tune with where mortgage rates are. I think if you're in the market to buy a house, or you live in a house right now and you have an outstanding mortgage, you have a pretty good idea of where these things stand. So you can see here that currently, or at least at the end of 2023, the 30-year fixed mortgage rate was about 6.6%. So this is above the recent historical average of just over 4%. But again, has come down relative to where it was not too long ago. I remember when interest rates, for 30-year fixed mortgage rates were about almost 9%, call it 8.5%. So rates are still elevated, but I think it's important to provide some historical context here. So of course, over the near term, when we've essentially been in this zero rate type of an environment, 6.5% feels dramatically large. And relative to recent history, it is. But when you extend the window and you look back to call it the 1980s, mortgage rates were, call it 14 to 16% during those years. So when you compare relative to, that time period, rates seem, dramatically lower. And you could make the argument that we were in an atypical rate environment before, when rates were essentially zero. We're actually normalizing a little bit now. But again, no question about it. The mortgage rate where it stands now is certainly higher than the average. You can see here that interest rates broadly have kind of followed suit. Of course, the Fed doesn't have the ability to control something like the 30-year fixed mortgage rate. That is driven by the forces of supply and demand. They generally control the Fed funds rate, which is at the short end of the yield curve. They have the ability to manipulate the longer end of the yield curve a little bit, but it's a lot harder to do, and they don't do it very often. So when you hear about the Fed moving rates, it's really that short end of the yield curve. But again, when the short end is moved, typically the rest of the curve follows suit. And that's what we've seen here, is that interest rates, across maturities have broadly increased in line with what the Fed has done. Like I said, 2023 was a phenomenal year for investment performance, really across the board. If you were in sort of any of the major asset classes, you would have been rewarded quite handsomely. So as I mentioned before, the S&P 500 was up about 26%. When you look at from a market cap perspective, what was in favor versus what was relatively out of favor. And when I say out of favor, I just mean what kind of struggled on a relative basis. There's nothing here that was negative, as you can see. But the smaller part of the market didn't keep up with the larger part of the market. The S&P 500 index, which is what most folks know of, that performance was largely driven by a few big names that comprise a big chunk of the index. And so not surprisingly here, you're seeing large caps having outperformed over the course of the year. Another sort of wide margin or wide discrepancy that you can see in performance here is that growth was heavily much in favor over values. So you can see that growth was up almost 40% over the course of the year, whereas value was only up about 12%. International equity, again, positive on an absolute basis, but incurred some relative headwinds, due to the geopolitical conflicts that we've seen. We have two major wars occurring over the throughout the world right now. And unfortunately for these international investors, these conflicts literally hit closer to home. So they tend to affect these markets a little bit more. We've also seen the US dollar continue to appreciate in strength for quite some time. And when you look at, returns in US dollars from an international equity investor's perspective, that is a headwind. So that tends to eat into the return story here for those folks. You could see that across fixed income asset classes, modestly positive returns. A similar story here in terms of what was driving fixed income performance, similar to what was occurring in the equity market. So it was very much a story of risk assets doing well. And the same thing happened within the fixed income universe. So you can see things like corporate bonds, high yield debt. These were the areas of fixed income that tended to outperform on a relative basis. This breaks down the sectors of the S&P 500 index over the course of 2023. So not surprisingly, you can see that information technology and communication services were the big winners from a sector perspective. Both of these sectors, returning in the ballpark of 55%, give or take. And the more defensive areas of the market tended to struggle on a relative basis. So things like consumer staples, energy, utilities, these were all, sectors within the US equity market that underperformed, relatively speaking. Again, it was that risk on, risk off type of atmosphere, and anything that was connected to, big tech or anything like that tended to do well. And those, the value-oriented sectors, within the US equity market tended to underperform, relatively speaking.
So quick little snippet question on that. How do you guys, with that type of negative year to positive year for the technology and space in particular. I know you'll get to this a little bit, but do you see those as overvalued now?
Yeah, so it's interesting. One of the parts that I love about my role the most is that I get to sit in all of the portfolio management meetings with all the managers who run our strategies. You know, we talk about what's going on in the world, what are they thinking in terms of portfolio construction, things like that. And so here at Morningstar, again, everything is quantitative. We're looking at the valuations of every investable asset class that we touch. And so we have models that derive forward-looking returns for everything from equity to fixed income, and then within equity, sector by sector, et cetera. And so when you look at the expected return for something like information technology, that is actually the lowest on the list of our US equity sectors right now. Not saying that the fundamentals are weak there, that is certainly not the case, but what bakes into our forward-looking expectation is current valuation. And the US information technology sector in particular has been run up in valuation for quite some time, that we just don't see that being able to sustain at the same level that it has been. So we actually like areas of the market that were out of favor last year. Some of the areas of the US equity market in particular that have some of the best forward-looking return profiles from our perspective include utilities, consumer staples, healthcare, basic materials. And then when you think of the areas that did well previously, but still have a lot of potential moving forward, we really like comm services. We think that's a pretty good proxy for information technology, broadly speaking. But when you think about the valuation that plays into that, it's not nearly as stretched. So we think the potential there is much greater relative to something like US tech.
So you're gonna watch WWE on Netflix, but not hold your breath on the AI front yet?
Hey, we have a lot of confidence in AI, but we think you have to be targeted in your approach there. Maybe not invest in the NVIDIAs of the world. Again, we think the valuation is pretty stretched in those companies, but we think there's a number of second derivative, second layer plays that can really do well on the heels of AI. But yeah,
Cool.
yeah. Very good. So this just represents the market concentration. As I mentioned before, it's been a very top-heavy market with large cap really pulling things along. And then within large cap, it's really been the story of a couple of names. And it's been these high-flying tech names that have really driven market performance overall. And you can see that it's the ones that, generally everyone knows: the Meta, Amazon, Apple, Alphabet, NVIDIA, et cetera. And so obviously, this has helped to generate fantastic performance for the US equity market in particular. But again, looking at what we think the intrinsic value is of these particular companies, we don't think the valuation story is the best thing out there right now for these particular companies. And that's really a testament to how well they've done, in recent memory here. Despite all of the noise that's kind of gone on in the world over the last several years, again, two major geopolitical conflicts, inflationary concerns, interest rates moving from essentially 0 to 5.5%, really unprecedented movement, if you will, in such a short period of time, and all of the implications of those interest rates, that we've had to deal with. The market is still hit all-time highs, on a number of different circumstances. So I think, this really highlights the importance of having a long-term view, a long-term orientation, and really, understanding that the market is pretty resilient. It can endure a lot of different things. I think the market's actually gotten better at enduring because of how much we've had to go through in a very short period of time. So I think this is good just to provide some context that, it can feel like there's a lot of doom and gloom out there. But when you sit back and you actually look at the numbers, you can see that, the markets have still done pretty well despite a lot of the noise that has occurred. And again, I think this highlights the story here when you extend the window and you look at asset class returns over the last 10 years, really a fantastic time to be invested in the markets. I know certainly over the last year when cash rates went to, 5%, a lot of people were probably thinking, hey, why do I want to risk my money in the markets when I could just, earn 5% in cash and call it a day? Well, the problem with that is that cash rates can turn on a dime. They can literally turn overnight. And if you have a long-term orientation, again, stretching this window out 10 years, virtually every major asset class has done well. So this represents average annual returns over a decade. So when you look at something like the S&P 500, the average return year over year for the last 10 years has been just over 12%. I think that's a pretty good place to be. And so you can see here, broadly speaking, across equities, a very strong performance story overall. As I mentioned before, growth has really been in favor. Certainly was in 2023. That's really been the story of the last decade in particular. It's been a risk-on, growth-favored type of market, and you can see that reflected in the index returns here. International equities have performed, relatively well. Like I mentioned before, the headwinds that international equity investors kind of encounter, particularly around a strengthening U.S. dollar. That's kind of eaten into returns a little bit. And then bond markets, again, they perform modestly well with the riskier areas of fixed income, outperforming on a relative basis. Again, this sort of highlights this sentiment here is that, I think this is helpful for me that I forget how much has gone on since, even January 2016. So if you go through each and every one of these events, a lot of these things have negative implications with perceived market performance, right? We had a global growth scare. We had issues around Brexit. We had trade war, issues. We had an unprecedented COVID-19 pandemic. We had 40-year inflationary highs. Really a packed, a packed few years in terms of potentially negative events shaking the markets. And what has the market done over the course of time? It's consistently gone up and to the right. And so I think this is important to kind of digest and really, every so often just take a look at, by the way, we've seen all this stuff, we've all lived through it, and, the market has tended to be pretty resilient over time. I think this is a good exhibit that highlights that. When you think about global equity valuations, again, we're looking at all the valuations really across the opportunity set here at Morningstar. That's something we do on a regular cadence. And so when you think about the regions of the globe and kind of where they're valued at right now, I would say, the US is arguably the most fully valued area of the equity market right now, at least from a regional perspective. And so you can see this highlighted here, represented by the forward PE ratios for the S&P 500, the EFA index, and the emerging markets index. So the margin between these, essentially between the US and then the non-US markets, that difference is really attributed to how much the US has outperformed over the last several years. And because of this outperformance, because the US has been so stretched in valuation, we actually think there is a lot of opportunity to diversify outside of the US. So we really like the valuation points right now for non-US equities, both in the developed space as well as the emerging market space. And when we say that, we're talking about, we like this at the margin, right? So we are a US-based asset manager. We are going to have a home country bias. We do favor the US, broadly speaking. If we have a multi-asset portfolio, you're not going to see us move our entire US equity allocation outside of the US. We're just talking about at the margin, we may like the international space a little bit more than another investment manager. So if you were to look at a model from a BlackRock or a Vanguard or some other provider within a multi-asset context, you may see them have a split of, call it 80% US equity, 20% non-US equity. We are still going to have that same general feel, but just at the margin, we're going to like international a little bit more. So our blend might be, 70-30 or 65-35, something to that effect. As I
And
mentioned,
is that something that's changed in the last year or two relative as you've seen this kind of spread increase a little bit? It's that kind of new conversations that are happening, or has that been for the last couple of years?
yeah, I would say it's been the last couple of years. I mean, I certainly, we've been calling for non-US equity to come around for a little bit of time here. Valuation I think is an easy thing to look at. It's just a hard thing to time. That's the hardest part of it. And so the valuations have looked compelling for quite some time. I would say, perhaps after the end of 2023, when US equities really performed strongly, relatively speaking, that story got a little bit more apparent, meaning that US equities got a little bit more stretched in valuation, so that margin may have increased a little bit, but not enough for us to make any dramatic changes in our portfolios. I would say we've
Nice.
kind of remained steadfast in our approach of the last couple of years.
Cool.
Yeah. And so this represents the Shiller PE ratio. Again, this is just kind of what this is a price to earnings ratio, but it adjusts for inflation so that it's kind of comparable over a long period of time. And so basically what this highlights here is that US equities are trading at premiums relative to both their historical average before 1990, as well as their more recent average since 1990. So, just kind of a good indicator of, what things have done historically and kind of where we're trading at today, just for us to get a sense of, is a certain thing undervalued or overvalued. And for this instance, we are looking at the US equity market, broadly speaking. What this represents here is the various asset classes, broadly speaking, and how they've done year over year since 2006. And this is a really noisy exhibit, and I think it's supposed to be. That's kind of the message is we're trying to convey here, is that it's very difficult year in and year out to predict which asset class is going to perform the best or perform the worst on any given year. So I think a good example is if you were to load up on commodities in 2007, right? You would have done pretty well. That was the second best performing asset class. And then, only a few years later, it was dead last and remained that way for 4 years straight. So it's very difficult to kind of put all of your chips into one basket, so to speak, and think you can ultimately time the market. We think having a well-balanced portfolio is ultimately the best way to have the smoothest ride over time. And so you can see here the returns of a balanced portfolio, which is essentially an average of all these different asset classes. And you're never going to see it at the front of the pack, so to speak, but you're never going to see it be dead last either. And I think this ultimately underscores the strength and the importance of portfolio diversification at the end of the day. And so, I think moving forward, this idea of diversification is, arguably more important now than perhaps even in the last couple of years, because there's just so much uncertainty in the markets. We're seeing things like inflation come down. That's been great. I think we've gone through the pain of interest rate hikes. We can't go much higher. I don't think we will. If you look at the world with through a probabilistic lens, I would say it's more probable than not that rates will come down versus go up. So I think we've kind of weather that storm a little bit. And we actually expect the Fed to, start cutting rates, somewhat aggressively in the middle half of 2024 and going out to 2025. But with that being said, we live in this very unpredictable world. And, you can only forecast so many things. And I guarantee that there is going to be something that happens in 2024 or 2025 that no one can forecast. It's just, an unpredictable world that we live in. And so we really think having a well-diversified portfolio at the end of the day is kind of the best course of action. And that's why, like I said before, we're very bullish on areas of the market that have been out of favor. So we like, within US equity, we like consumer staples, we like healthcare, we like materials, we like utilities, we like banks even. Banks, we think from our perspective, were oversold, given some of the regional banking issues that we saw in early 2023. And we actually think the fundamentals are pretty strong there. So, within our multi-asset construct and our multi-asset context, we are actually overweight in areas that, other folks may not love. And we think ultimately at the end of the day, that diversification is going to be a powerful thing because again, you look at some of the best investment managers, at least over the last few years, why have they done well? Well, they've had a portfolio loaded up with US information technology. Granted, that's done very well, but is that going to be the same going forward? I'm not sure. So I think diversification is more important than ever. We like the smaller end of the equity market in particular, like I mentioned before. The valuation story is really nice there. And then, on the fixed income side of things, I think there's a lot to be excited about just in bonds, for bonds in general. We think that entire universe is way more attractive, right? So if you look at, again, that the sharp increase in interest rates caused a lot of pain along the way for bond investors in particular, but it's also created a fantastic entry point for bonds right now. So the entry point from a valuation perspective is very, very compelling. But then when you look at the yield component, bonds are actually, yielding positively on a real basis. So after inflation, for the first time in quite some time. So the risk return profile of bonds, broadly speaking, has improved dramatically, and it's something that we're really excited about. Within our multi-asset models, we're not taking on more risk than a benchmark right now. If anything, we're actually overweight bonds in our portfolios because of how compelling we think that bond story is. But again, we think there's a lot of uncertainty in the world. It's going to be important to have a diverse portfolio. It's going to be important to incorporate quality. So, on the fixed income side of things, incorporating, healthy government debt that doesn't have a whole lot of credit risk. We think credit's not the best place to be right now. And then on the equity side of things, those value-oriented areas of the market tend to have defensive characteristics. And we think that improves the quality profile overall of portfolios that utilize those exposures. So, a lot going on, but I think it's more important than ever to, diversify and have a high quality portfolio at the end of the day. So I just did a lot of talking. I will pause there and I'm happy to, answer any questions that you may have.
Perfect. Thank you. A lot of information. Love it. We are recording this webinar, so if you want to listen to it again or see it or jump back to any piece of it, we should get it up on the website here within a couple of days once we get it edited and through compliance. But a couple questions. Sounds like so a lot of folks fearful of recession. We've seen a lot of the recession indicators falling over the last year. Kind of a 50-50 consensus right now on a recession happening with a likely soft landing. You mentioned that you guys are looking forward and seeing later in the year potentially some rate hikes or rate cuts from the Fed.
Yeah.
What I guess just from a general consumer standpoint, what do you see happening in the economy that leads to that optimism?
Yeah, I think, like I said, inflation is going in the right direction. I think we haven't seen, the full effect of the interest rate hikes yet. There's obviously a lagged, there's a lagged effect with those things that, those things take some time to kind of matriculate through the system. And so, we are seeing inflation come down. Again, I don't think inflation has come down to the same magnitude yet that interest rates have gone up. So I think the interest rate hikes will continue to bring those levels down. And I think the data there is pretty encouraging. We've also seen supply chain disruptions ease quite significantly, and that's helped to bring inflation levels lower. So I think everything is in place, and inflation is going in the right way directionally, that at least according to our chief economist's opinion, he thinks we're in a good spot to for the Fed to start cutting things somewhat aggressively.
Nice. Another question. So we're all a question about cash. A lot of folks are sitting happy with savings accounts and money markets paying, 4 or 5% range.
Yeah.
What's your thought or take on getting cash to work with a competitive bond market now, priced well, versus sitting pretty enjoying a savings account or money market that may be running on a 7-day average, interest rate? How confident are you guys actually putting that cash to work in certain areas to maybe secure more yield for a longer time period on some of the bonds that exist versus?
Yeah. I would say we're very confident in that. I think cash rates, while very attractive, like I said, they're very fleeting. They can turn on a dime. And even if you were to invest, the money that you had invested, just in essentially your cash, if you were to invest that in, products in the short end of the yield curve, you're still locking in for longer than cash rates could be. And so, we just think that is warranted at this particular time. We also, when you look at fixed income, with a longer maturity than that of, something extremely short like cash, there's a duration component as well. And so again, if you look at the world probabilistically, and you assume that there's, I don't have a crystal ball, I certainly don't know for sure, but it's more probable than not that rates will come down versus go up or stay the same. Well, if rates come down and you have a healthy amount of duration associated with a fixed income portfolio, you're going to see a good bit of price appreciation there. So not only do you have the better yield picture and the better yield story because of rates, and you can lock that in now, but because of the duration associated with it, and then with rates coming down, you'd also get the price appreciation there. So from a total return perspective, you'd be doing much better than cash.
So if it stays the same, you're doing all right, and if it
Right.
goes down, you get paid.
Right.
Cool. Let me see. I think there was one other. I think that I tied two of them together. I don't think we have much else for you from a question standpoint. Really appreciate your time and the work going into putting this together for us. So it was a pleasure, Brian. Everyone that joined, thanks for joining us. If you have questions or want to link to this, you can share it with friends, whatever you want to do. It's on our website, or Amber can get it to you. So just let us know. Hope you guys have a good rest of your day, and we'll sign off. Brian, thanks again for your time.
Absolutely. Thanks very much for everyone being here.
All right, take care, Brian.
Okay, bye.